Welcome to the Smart Property Investment Show with your host, Phil Tarrant.
Hi, good everyone. Thanks for joining us today. You might not have heard my voice for a couple of episodes. I've been on holidays, which has been quite nice. I spent some time with the family over in Europe for a couple of weeks, which is always good to get away and recharge and reassess where you're going with your lot in life. And I spent quite a lot of time thinking about property over that period of time. And I've come back to Australia only a couple of days ago. I think there's a big report on 60 Minutes about how property is going to fall by 40%. So take that as you will. Obviously, it makes for sensationalised headlines, which seems to be all the rage in the media. Personally, I think you should be quite measured about the information that you receive and how you go about dissecting that or understanding what it means for you, whether or not property is going to come off 40% or not. I'm not qualified to say yes or no that's the case, but my talkings with people right across the industry would indicate that the fundamentals for growth in property is still quite solid. One of the challenges that we do have is the fact that it's hard to get money at the moment. Banks are going through quite a period of change, and I think you'll see quite a lot more moving forward as a result of the Royal Commission and recommendations coming out of that. So watch your space, but you can't really do too much about what the banks do, and you can't really do too much about how the regulators are going to police property investment. But what you can understand and what you can control is your own cash flow, your own appetite to risk, your own ability to manage your portfolio and make decisions that you need to make. So if you feel as though you're a bit lost in the wilderness at the moment, get connected with your portfolio, know the ins and outs of it. And I've spent the time of my break sort of going through mine. So I'm pretty confident where I am right now. I'll be looking for opportunities moving forward. Anyway, that's nothing to do with our conversation today and our guest in the studio, Dominique Grubisa. We're going to have a chat about distressed properties. I've secured some good properties in my portfolio, which I would say was on the distressed side. Often you can get the best buys when you're identifying properties which are in distress. But I think Dominique plays a slightly different game in that regards. Dominique, how are you going? Thanks for joining us.
Hi, Phil. Thanks so much for having me.
What do you know about distressed properties?
Well, I've got a legal background.
Okay.
So I came up through the ranks as a solicitor, then a barrister, and I started growing my own property portfolio, and I was always looking for the needle in the haystack, that under market value property. And I just, through focus, just sorted the wheat from the chaff, spent a lot of time sharpening my axe. And when I found something that was good value and below market, usually a motivated and negotiable vendor, I'd just jump on it. And what I noticed was there was often a legal reason that was their foundation for needing to meet the market at that price. So the big ones were, and it's the ones everyone looks for, the mortgagees, the deceased estates, bankruptcies, liquidations, sheriff sales, and they all hit a legal radar long before they ever come out the market on the other end. So I started focusing my search earlier on, before those properties hit the distress button and a third party started selling for them. So deceased estates have to go through the courts. There's probate notices that notify you of those. Similarly, mortgagees, if a bank's repossessing, they have to file in court. So I concentrated on the court process, and I actually found a bit of disruptive change. There's a far better way of doing things and of helping sellers and motivated vendors and beating banks and third parties for a win-win. So it helps you grow your portfolio and it helps someone out of a sticky situation.
So rightfully, it is the holy grail, it's the needle of the haystack, it's whatever you want to call it, these undermarket properties. That's what every investor is looking for. Well, most investors, by the way, other people have different strategies. But and I know now that you help other people through this path of identifying distressed properties in your business. But today I really want to dig down into your personal story and how the genesis of this thought process and this strategy that you have to invest in property through identifying distressed assets. And you have a legal background, which gives you a particular set of skills to actually understand the intricacies and nuances of a lot of the stuff that you've just explained in terms of deceased estates and stuff. Is pretty full on. Before we go any further, can you just give me a definition of a distressed property? What is it?
It's one, in my view, my definition is one where the vendor is time poor. So they're under some time duress and they have to meet the market and move quickly. Otherwise, they'll lose complete control, and a liquidator or a trustee in bankruptcy or a bank or somebody else will move in. So they're highly motivated.
So someone's under pressure, pretty
Yes.
much. Okay. So distress means there's a pressure somewhere for someone to either shift a property really quickly because it's a commercial concern or a financial concern, or shift a property really quickly because there's some other issue associated. It might be an emotional thing or a family thing or a divorce thing or whatever it is. So that's a distressed property.
That's exactly right,
Okay.
yes.
So why have you chosen to develop your strategy of property investment around identifying distressed properties? What's the backstory? Have you always done that, or is it, through some other circumstance that you've started going down this path?
Well, it happened organically. At first, I was very strategic in my 20s and I was very controlled as an investor. So I looked for the needle in the haystack. And then in the heady days when the property market heated up in the 2000s, and banks were just lending to anyone who could fog up a mirror, I just got as much credit as I could. I bought as much as I could. I strayed from the formula. I started buying high, wide and handsome, anything off the plan, whatever I could get my hands on, who'd ever give me a loan. And I thought you could never, ever go wrong in property because I personally hadn't ever seen a bad market, and I got lucky early on. And so off I went, and I went outside the rules and the parameters, and I had massive, massive debt. But I thought that leverage was a good thing. What I didn't realise that, great, it magnifies your profits, but it also rebounds and really magnifies your losses. So I got completely blindsided and I lost everything in the global financial crisis. And that was like being hit by a runaway train. So not only had it taken me many, many years to build up wealth, but I ended up in a really short space of time with millions and millions of dollars of debt over my head, just in a black hole.
So what actually happened? So the global financial crisis, I think anyone who invests in property is familiar with this, but how did you lose everything? Was it the assets that you secured as a property investor, the inherent value of them weren't there, or you couldn't service the debt that was associated with it? What actually went wrong?
All of the above. I think it's like the Titanic for me. It was never, ever one thing. It was just a knock-on effect. So, yes, first of all, really, really leveraged, no wriggle room, a lot of debt, and depending on the market, always going up, and it just didn't go up. We had property development sites where we were waiting for loans from the bank to start construction. So that was just more debt. We were just hemorrhaging money and we couldn't rent out that property or get any income. We needed to build and the banks pulled the loans.
So we just overextended. Is that the main issue, do you think? It was just too much at one point in time?
Yes, but it was at a time where the market flipped really, really quickly and everyone else was overextended and I got caught up in somebody else's domino effect because I had lent money to somebody and I was getting income on that. So caveat, short-term money to...
So you were funding other people's developments, were you?
Yes.
Okay.
And so when somebody else went down, they went bankrupt, a trustee in bankruptcy stepped into their shoes and started clawing back money. And they'd actually paid me back, but... what happened was the trustee in bankruptcy said that was a priority payment, and under the Bankruptcy Act, he clawed that money back, and that was multiple seven figures. And I just got sucked into a vortex. So that went to court. I thought we could win in court, and it was just rats from a sinking ship, and we actually lost the court case. So we had to pay millions of dollars to a trustee in bankruptcy back, and the loser pays the winner's costs in legal court cases. So we were just down for the count.
So what do you have to do? Just liquidate your whole portfolio to cover that debt? Is that what you did, or how did you sort of...
That was tempting. A lot of people around me did that. I chose to fight, firstly because as a lawyer you can't have a practicing certificate if you've been a bankrupt. And secondly, just on principle, I thought I'm just going to put all my energies into focusing on beating this thing and working it out. I just had nothing left but my brain because all my money and assets had gone. So I just funneled all my knowledge into the law, and there's no real experts. There's no high-priced legal experts who specialise in helping people in debt because there's no money in it. But I had been at the heights of law as a legal expert, and I had a far more powerful motivation for focusing on debt law, and that was my own self-interest.
What sort of law did you specialise in at this point in time?
At this point in time,
Yeah.
I was full on into property law. So
Okay.
I had no knowledge around debt except for basic legal knowledge of where to look in statutes and where to focus and what your rights were. And I just drilled down. It was very, very narrow but very deep niche in the law.
Talk me through the point where you feel you're at right at the bottom. Can you actually identify, looking back now, 10 plus years when you went, that can't get any worse than this?
Yes, I actually remember rock bottom for me quite vividly. I had young children, so we actually had twins. We had 3 children under 2. And what happened when the GFC hit was we were at rock bottom, literally homeless. So we'd lost absolutely everything. And there was one day where I had to ask, we still had a portfolio. I was still just treading water, robbing Peter to pay Paul. And I asked the managing agent of one of the investment properties if there'd been rent. So instead of getting our rent paid monthly, I was just ringing agents every day going, any rent, put it in the bank. So she transferred. She was very good. She had to walk around to the branch of the bank with cash so it could be there immediately. And I was waiting on the street at an ATM and I put my card in to get $300 to help us just through the weekend. And I had these 2 little twins who I couldn't afford to send to kindy anymore because I couldn't sneak past the lady who was like the debt collector basically because there were too many weeks where I'd said, did the check, my husband must have, I don't know what's wrong with that credit card. So I was too embarrassed. So I'd kept them at home for the day rather than face her. And the kids were fighting over pulling the money out of the hole in the slot of the ATM, and it got left there too long and the bank, it got sucked back in. So I went into the branch and they said, sorry, we've got to reconcile, come back next week. So I literally had not a cent in the world and I just sat down on a bus bench and just started bawling my eyes out.
And what button did you press inside your brain to actually get up from that bus shelter bench and start going, all right, it's got to get better than this. How do I move on from this? What did you do?
I went to my mother-in-law's. Luckily, she took us in and we could sleep on a fold-out bed and we were just under their roof and just a family of 5 of us. And there just came a point, it was one Saturday night and I was sitting with my parents-in-law watching 7 Brides for 7 Brothers, as you do. And I just thought, this can't go on. I'm a mother, I'm a professional, I'm a businesswoman, this is not the life that I wanted for myself. So I think I had a paradigm flip and I adopted a glass half full approach. I thought it is what it is. I've lost everything. I've lost assets, pride, dignity, self-esteem, standing in the community. But one thing that no one will ever take away from me is my brain. I've got knowledge. I just have to use my smarts, my street smarts and my education to think my way out of this one. And then I just focused on that.
So at that point in time, how big was your portfolio? How many properties were in the portfolio at that point in time that you still had?
We had about 20.
Okay.
We may have at rock bottom whittled it down to about 10.
Okay. A lot of people still think that's a big portfolio for someone to be at rock bottom. Did you ever just go, I've had enough, that's it, just cash out? Or what I'm trying to get is this point of resilience to keep moving on. What was the first win that you had when you hit sort of rock bottom?
Well, I'd actually burnt all my bridges, so I couldn't just sell them. They were underwater. So I'd got 95% loans, mortgage insurance, 97% loans, whatever money I could get my hand on.
So the problem was potentially negative equity if you did sell them. So
I couldn't sell them.
You were stuck.
Yeah.
Okay.
So I just compartmentalised, and so I thought, this property, what can we do? And I just focused on that. And some of them we could get executive rentals, and it meant borrowing money, getting further into debt because we had to get furniture packages because we could get a lot more money from them furnished on short-term leases. And so it just meant having to just roll the dice, dig down, take more risks and just trade our way through it.
And you traded yourself through it?
We did, yes.
You did. Do you look back on that period now and say, is there any fundamental issues when you were at that point in time creating this portfolio that you would do differently today?
Yes.
Is it buying different assets? Is that what it is?
Yes, exactly. I'd start with the end in mind. I'd have a strategy and I wouldn't get emotional. So we got emotional and we just started buying things. We thought we were 10 foot tall, bulletproof, and whatever we touched would turn to gold. And it's easy to feel like that in a good market.
Yeah, and I think a lot of people, their paradigm is there's a lot of investors out there who think they're really good at investing because they bought assets in in the western suburbs in Sydney for a period of time, or Sydney over the last sort of 7 or 8 years, and a lot of that stuff's doubled. So they think they're geniuses as property investors. Look at our portfolio. We bought quite a lot of properties in Sydney sort of 7 years ago, and we've done exceptionally well out of it. So, if that becomes your paradigm, it's like someone at the racetrack who always bets on a favourite and then they stop sort of winning. I think we're in a market, we're moving into a market now where if your paradigm is, doubling the value of your property in 4 or 5 years, as we've seen in Sydney, you're probably in a spot of bother. So whether or not people are going to end up in the same position in this current market, I'm not too sure, but it all comes down to buying the right property. So going back to your particular strategy now, it's about buying distressed property. So I guess there's two different things. You under market property and there's a distressed property. And under market property just might be marketed badly by a real estate agent, but there's no inherent distress in that property. What we're talking about is the next stage down where there's death, there's divorce, there's debt. These are true distressed properties where there is a factor of time, which is really important, a factor of urgency, and that's where you can really capitalise as a property investor. So how do you go about finding a distressed property? What's the secret?
Well, there's two types. There's on-market and off-market. So I would define even, as you said, Phil, bad agent as a form of distress, because when you look at those types of properties, you often see a pattern. They've been on the market a long time. If they've changed agents a few times, there's always a story behind that. Sometimes the vendor has committed elsewhere, which puts an element of time distress on it. It's always about time. So if you're unemotional and if you're objective and you're looking at this as a business and you're just running the numbers, then you'll see opportunity everywhere. So on market is just they're trying to sell for whatever reason. Time ultimately becomes an issue and they're very motivated and conditioned and they'll meet the market. And the off-market ones are ones where you can approach them prior to it even coming to a point of reaching the market, because you can identify that there's some distress. It doesn't mean they'll sell to you. It just is a form of sourcing opportunities.
So if I am listening to this podcast and going, oh, this sounds good, how do I start working out sort of what properties may be distressed at a point in time? So they're not on the market, they're off the market, and it might be at a point in time where someone's trying to rationalise a deceased estate and shift stuff through, or there might be contention between siblings and, stuff's in court. Where do you find that information?
So it's all public record. You can see court lists. You can see, it depends on the type of distress, but they all hit a public radar, either at the time that proceedings are started, like someone sues, like a bank sues, that will be filed in court, or it may be when they go for probate for a deceased estate, they have to put a public notice out there that they're intending to administer that estate. There's different publications in every state and different ways that it hits your radar, but it's about understanding how to do that research, and then the legal system. So how the legal system is structured and what that means. So there's an executor of an estate and there's certain clauses that will go in a contract for sale when you're buying a deceased estate before probate. So there's a technical side as well as a sourcing side, and that's what I teach people.
So just let's learn a little bit of your teachings then. So if I see there's some sort of probate notice and there's an issue and a problem there for an opportunity, what do? Do I pick up the telephone and give someone a call and say, hey, do you want to sell your property? How does it work?
Yep, there's a few options. So you can talk to the solicitor who's handling the probate and say, I've become aware that I'm looking at this property. I understand that it's under administration or probate and that you're handling the estate. How can I best make an offer? And the solicitor's duty is to the estate and the trustee and the beneficiaries. So they will put you in touch with them, or the probate notice will actually say who is the executor. So you can write to them. Sometimes you can just write to the address of the property because the mail gets redirected. Now, it doesn't mean that every single deceased estate is going to go on the market. Sometimes there's a surviving spouse who will still be in the house, but often, and the cases that our students do, what we'll see is there's maybe 4 children, for example. One recently, last week, there were 4 children. One was executor. They were all interstate, and the executor had the siblings saying, hurry up. When will this sell? When will we get our inheritance? So she was cross that she was left with all that responsibility. And there was 75 years of hoarding and rubbish and stuff in the house. And what the buyer said, who was one of our students, was they were just able to solve that problem. They said, I can commit to a price now. It saves you the advertising, the marketing, the agent's commission. Plus, we're going to renovate it. We'll get in, we'll clean it all up. We'll have a garage sale. We'll we'll empty all the rubbish, and you can all just stay interstate, and it's money in the bank for you. So it's solving problems.
So can we just cover off a couple of terms that you're using here that our listeners might not be familiar with? What is an executor? What do they do?
So when someone dies, if they leave a will, they'll appoint an executor. So husband and wife, it's usually the spouse or an adult child. So that's the person who stands in the shoes of the person who's died.
Okay, they make the decisions on behalf of that person.
That's right.
Okay,
So all the assets get turned into their name, and at Land Titles Office, for example, a property will be changed over into the name of the executor as trustee on behalf of the deceased estate, and they can then sell it up and give the beneficiaries their money.
Okay, so what's a trustee?
So a trustee is someone who holds property because it's got to be held by someone, but it's not actually theirs. So if you and I were to buy a property and we bought it in our own names, the law would say that's our property. It's our money that's gone into it. We get the benefit of it. A trustee is someone who's holding it and they're registered on title as owning it, but it's not really theirs. They're just holding it for the benefit of someone else.
Okay, so they make the decisions around the property, but they're not the owner of it.
Yes, and the decisions aren't for their benefit. They have to do it in the best interests of the person they're holding it for.
Okay, and the person they're holding it for could be the beneficiaries.
Correct.
Okay, so what is a beneficiary?
Someone who's entitled to the benefits or the fruits or the profit, the wealth in that property.
Okay, so I hope that's really clear for everyone, because it can get quite confusing if you're not familiar with those terms. You work with them every day, as do I. But is there any other sort of terms that we should be really looking at as part of this process when you're looking at deceased estates? It's pretty much covers it. What's probate?
Probate.
Yeah.
Probate is, so when someone dies, we're talking about a lot of money, especially where there's property, so hundreds of thousands of dollars, and there's a formal legal process around it. So you can't just say, Granny Jones has died, give me the house. It has to be vetted by the court. So they'll have to see the will and the death certificate and just rubber stamp everything to make sure the people who are actually getting that wealth, that all the boxes are ticked and it's all perfectly legal. And there's laws around it. Someone may want to challenge the will, or there may be a great long-lost daughter or grandchild who says, well, I'm entitled. And so that's why they place ads, and there's all these notices and a whole process that they have to go through before they can sell that property.
So probate then is that process of, I guess, transitioning of assets and making sure it's all done appropriately and legally and people get paid.
Exactly right, yes.
Okay. All right. I think that's covered most of this. I'm trying to think what other terms it might be. Because if you're going to dabble in this space, looking at capitalising on deceased estates, and that's one type of distressed property, you probably need to know that pretty quickly. So if you're in different states, there's different processes. It's by and large a similar process, but there's different steps and different resources you can use. If you were thinking about potentially looking at sort of deceased estates, what sort of website should you be looking at to help you sort of on your way and understanding, say we're recording New South Wales at the moment, where do I go to look at all this information?
So the Supreme Court website is where they would file probate notices in New South Wales, but in other states it might be an ad in the newspaper or a government gazette, or Queensland, it's the Queensland Law Reports. So it varies from state to state, time to time.
And if you're looking to capitalise on let's say with deceased estates, because of one of the many distressed type of properties, what sort of skills do you need to be good at doing it? Because you're dealing in often an emotionally charged situation where you have a lot of conflicting opinions sometimes. If there's 3 or 4 children who may be the recipients of inheritance and property, you don't know the background of it. So often you're to the point you made before, you might be a bit of a mediator or a problem solver. You probably need a certain degree of empathy to be good at this. What other skills do you need? How do you go about doing it?
I think just the same as any property investor, it is about your own personal mindset and frame on the world. So a lot of people come to me and say, you're a vulture. Dealing in distressed property, you're a vulture. I think that's their preconception, and that might be their wound or their baggage. Personally, because I've actually been there and been where those people are, I know that it's any port in a storm. If someone had have come to me and said, how can I help? Can I do a joint venture with you? Can we look at a win-win solution around your property portfolio? I would have been so grateful. So it's, first of all, reframing the way you look at distress, because there are people on the other side and you're not taking advantage of them. You may be helping them. If they're not interested, then walk away, and they'll walk away, and that's fine. They often become motivated later on. So I always suggest to people to, if there's no animosity and they just say it's not right now, to stay in touch. So a bit of emotional intelligence, but as with any property purchase or investment, it's about your negotiation skills and understanding. And by that, I don't mean a win-lose negotiation where you're fighting over price and a piece of a pie. I mean a win-win negotiation where you're actively listening to what they want and thinking creatively for solutions.
So how do you know if you're getting a good deal?
I personally, for all our students, we're very aligned with CoreLogic and all their suites of products. So RP data, all our students, I give that to them as part of our program, because I believe, having fallen short because of lack of knowledge and research, I definitely believe in your due diligence and your numbers, and they have the best up-to-the-minute data. So we use RP Professional and other products in doing research and checking out what the market is worth.
So it's quite a lot of time and effort and energy and attention that needs to go into identifying distressed assets and realising the value of those through acquisition. Is it often, sometimes you just go, it's just too hard, you know? You might get a discount on the purchase price based on it being under market value, but the time and effort to actually do that might just be easier just buying stuff straight off, normal open houses or auctions. What's your view on that? Is it worth the time and effort? Like, what sort of premium in terms of discount should you be trying to achieve because of the effort you need to put into doing this?
I always suggest 10 to 40% below market value. And I think it's just horses for courses. There are people who are time poor and they'd rather pay a buyer's agent to do all that heavy lifting for them and research. There are people who have the time and the focus. And I think it was Abraham Lincoln once said, if I needed to chop down a tree, I would, instead of hacking away for 3 hours with a blunt axe, I would spend a good hour sharpening my axe and then knocking it over in 5 minutes. And that's what I look at the distress process and the research as, sharpening your axe.
And can anyone do it?
They can, with the right tools and the right knowledge.
Okay, that's a good point. Dominique, I really enjoyed it. We've only really just touched the surface of distressed assets, but we do write about it a little bit on smartpropertyinvestment.com, and it is the needle in the haystack, right? It's what everyone wants. Everyone wants to feel like they're getting a good bargain. So often you've got to do the heavy lifting to make sure you do that, right? And digging through court papers, if that's what excites you to do on a Friday night, I reckon there's some good opportunities. What's the best deal you've ever heard of? Anyone ever getting as a distressed asset after putting in the backbreaking labour into identifying it? You know, some really good deals you've ever heard of?
Yeah, many of our students will buy and sell in the same market. So they'll buy under market, and often when there's distress, if they can't afford the property, they usually don't keep the property well, or if it hasn't sold or they couldn't meet the market, there's a reason for it. So a lot of them are hoarders, and that really suits renovators because they can get in and clean it up, and the owner's stuck between a rock and a hard place. So the best types are the ones where they'll do a joint venture with the homeowner, which suits people who can't get finance in this market or find that challenging, don't have the deposit. So the homeowner brings the distressed property to the table, and the student and the investor brings the knowledge, how to deal with the banks, how to stop it, buy time and add value to the property, and then they'll sell it. So the best sort of deals are those ones, and people can make...
As in they never actually own the property, they just get a bit of an arbitrage on the outcome of it. Is that pretty much how it works? Okay.
And there's legal documentation to protect their position in that transaction, and people can make 6 figures doing that.
So that's another component of this, is not buy to hold or buy to rent out. It's actually just being a facilitator to help someone shift a distressed asset, and you make a margin on that process that goes through. So Haven't got time to cover that today, Dominique. Maybe we can do that at another point in time, because I think it's another strategy which obviously works well for people. But thanks for coming on today. I've really enjoyed it.
Thanks so much, Phil.
It's gone half an hour. That I thought it was like 10 minutes or so, but really interesting stuff. I hope you've enjoyed it, and we'll be doing a lot more stories like this moving forward. We like to look at all the different strategies available to property investors, and often something like this, which is pretty much the same thing. It's just actually a new way or a different way to actually identify the assets that you want to buy. But I think you could probably learn a lot from Dominique's story around what was a pre-GFC portfolio, where thinking that anything that could be purchased was going to turn to gold, and obviously come unravelled because of environmental factors outside of her control. So there's a message in that, and I'd keep that in the back of your mind as we shift through these changing markets, particularly when you're looking at some of the assets that people are buying, and quite a lot of building of new properties in certain areas as well. So just be careful. You can control the properties that you buy, and you can control how much energy and effort you put into doing your research and actually crystallising, understanding your strategy. So go out there and do that. We'll be back again soon. Until then, remember to check out smartpropertyinvestment.com.au. If you want to keep connected with us on social media, just search Smart Property HQ. Like us, follow us, and you'll make sure that you are connected with everything that's happening in property. And at a point in time when our market is in a state of flux and lending is in a state of flux, you need to be informed more than ever before. So go and check it out. We'll be back again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs, and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.